Hey folks, welcome to another video by Stock Trades. My name is Matt, and today we are going to be looking at the stocks which are expected to raise dividends in the month of January. Before we get into that, I just want to let everyone know that we are going to be launching our New Year's promo very shortly. Link is in the description, so please, if you're interested in joining Stock Trades Premium, now would be a good time to look it up. And with that in mind, we are going to get right into the stocks that are expected to raise dividends this coming January. Before we take a look at the stocks which are expected to raise dividends, just a reminder, we are covering the stocks that have a long history of dividend growth. So that means either Canadian Dividend Aristocrats or All-Stars, which have a 5-year dividend growth streak. It's important to note there is a difference between the All-Stars and Aristocrats. I've covered that in detail in one of our previous videos. Here's a link. Be sure to go check it out if you're interested, but both have some nuances with respect to inclusion on their lists. My preference is a Dividend All-Star list, but the Dividend Aristocrat is also a list worth considering. At their core, these are companies that have a 5-year dividend growth streak. It's really the difference is based on how they calculate that 5-year dividend growth streak. And with that, let's jump right into the handful of stocks which are expected to raise dividends, starting with Canadian Utilities and Atco. Atco and Canadian Utilities are well-known dividend stocks here in Canada. If you take a look at the company's chart here, you'll see that Atco is actually the parent company for Canadian Utilities. Not many folks know this, and they usually might think it's the other way around, given that Canadian Utilities has a higher market cap. But no, Atco is the parent company, and Canadian Utilities is a subsidiary of Atco. One of the interesting aspects of both companies is that they have a long track record of delivering. However, in recent years, if you notice, the company's earnings have somewhat plateaued. This is especially true at Atco. In 2019, the company's earnings dipped below 2013 levels, and Canadian Utilities, although still growing, you can see now that the chart is starting to flatten, which is one of the reasons why both of these companies have underperformed their peers over the past couple of years. One of the reasons why Canadian Utilities is seeing the company's revenue slip somewhat is because last year the company sold its fossil fuel-based electricity generation business, which really had to do with coal-fired and natural gas-fired electricity generation assets, which were located in Western Canada. And they totaled approximately 2,300 megawatts. So the company sold that, which did impact company revenue. In 2020, the company is going to exit the year with natural gas accounting for about 75% of wattage, hydro accounting for approximately 24%, and solar only 1%. The company is shifting from a traditional fossil fuel-based electricity company to a renewable electricity generation company. Despite the fact that Atco and Canadian Utilities have struggled in terms of growth, there is no denying the company's track record of dividend growth. Let's start with Atco. It has a 27-year dividend growth streak, over which time it has averaged approximately 10% dividend growth. 27 years of dividend is nothing to scoff at, and in fact, it is the 5th longest streak in Canada. Turning our attention to Canadian Utilities, this is a company that has the longest dividend growth streak in the country. At 48 years and counting, it is the one Canadian company that is the closest to becoming a dividend king. Dividend kings are companies which have raised dividends for at least 50 consecutive years, and Canadian Utilities is within striking distance of that impressive record. Although growth at these two companies have slowed in recent years, they are the closest thing investors are going to get to a guaranteed dividend raise, unless of course there is a catastrophic event. Overall, however, these are two of the most reliable dividend growth stocks in the country, bar none. Unfortunately, they are also among the lowest growth utilities in the country as well. Atco is the only utility expected to post negative earnings growth next year, while Canadian Utilities, at mid to high single digits, has the second lowest expected growth rate among its peers. So what you're getting with these two companies is reliable dividend growth and lower earnings growth. So between the two, I would consider them more like a bond as opposed to a high growth company, but both make for excellent solid income stocks, and there is no question in my mind that both of these companies will be raising dividends in early January. Next, let's turn our attention to Metro, which is one of a handful of grocery stocks on the TSX index. It has also been one of the better performing stocks in the industry over the past decade. This past year, Metro has been the second best performing grocery stock, if you will, trailing only Empire, with gains of approximately 8% this year. It's far outpacing the TSX and some of its peers such as Loblaws and George Weston. One of the things that attracts us about Metro is the fact that it has a 25-year dividend growth streak. This is by far the longest in the industry, and it is good for the 9th longest dividend growth streak in the country. Over this period of time, the company has raised dividends by double digits without fail. This past year, the company did extremely well given the uncertainty revolved around the pandemic. If you see here, the company posted sales of just shy of 18 billion, which is up approximately 7.7% year to date. Net earnings jumped by approximately 15% to $3.27 a share, and this is despite expenses related to COVID jumping, totaling approximately $137 million. The company recently acquired Jianghu Group, and it achieved further synergies with respect to that acquisition of approximately $69 million. So the company is well positioned for growth here. And this past January, the company actually increased its targeted payout ratio to between 30 and 40%. Previously, the company's dividend policy was to pay out between 20 and 30% of earnings. In January, it raised dividends by 12.5% to 90 cents per share. And at the moment, the dividend accounts for approximately 28% of earnings. Looking forward, the current dividend accounts for only 25% of earnings. So this means that the company is well positioned to deliver double-digit dividend growth well into the future. Now that the company has raised the targeted payout ratio, we expect the company to match last year's dividend growth rate and at least raise by double digits. Once again, this is almost a guaranteed raise. You are talking about one of the best dividend growth stocks in the country. Next up, we have another top 10 Canadian dividend aristocrat, which is Canadian National Railway. CN Rail has a 24-year dividend growth streak and is tied for the 10th longest dividend growth streak in the country. Once again, we are talking about a blue chip company that is all but guaranteed to raise dividends. The company has generated $15 billion in total revenues last year. It has a market cap of above $100 billion. It has managed to achieve a 15% return on investment. It generated $2 billion in free cash flows and is expected to spend another $4 billion in capital investments. Quite simply, this company is a behemoth. And since it forms a duopoly with CP Rail, it makes for a very attractive investment. As you can see here, it has constantly outpaced the market over the past decade, and we expect it to do so well into the future. Over the past year, it has gained 22%. It has returned 104% over the past 5 years and 411% over the past decade. In comparison, the TSX index has only returned 76% over the past decade. CN Rail is also one of the most profitable and has been among the leading growth companies in the industry. The company has achieved a revenue ton per miles CAGR of 2.4% since 2013, which is the top amongst all publicly listed North American railways. Its Canadian peer, CP Rail, has only come in at 1.1%. Furthermore, it has a middle-of-the-pack operational efficiency ratio of 61.7%, which is far above its peer CP Rail, which comes in at 59.9%. The company simply has an excellent track record. No doubt that the company's operations have been impacted by COVID-19. You see here that revenue has dipped by 10% through the first 9 months of the year. Net income has dropped by 24% over the first 9 months of the year. And adjusted earnings per share also dropped by 15%. All this might lead one to believe that the company will take a cautious approach to raising the dividends, but fret not. Despite the lower than expected revenues and impacts to earnings, free cash flow still jumped 39% over the third quarter of 2019. So you'll see here that the company is well positioned to raise dividends. COVID-19 is having an impact, but the company's stock price is not reacting all that negatively to it. It is up by approximately 22% this year. So let's get to the dividends. This is a company that has raised the dividend in every year since it IPO'd in 1995. It has a 37% adjusted dividend payout ratio in 2019. Now that jumps to about 50% over the past 12 months, but looking forward, that is expected to once again drop to 37% of earnings in 2021. So although the current pandemic has impacted operations and has impacted earnings per share, we still see that the dividend is well covered. The company has averaged a double-digit dividend growth rate in the mid to high teens over the past number of years, and we expect that the company will likely raise dividends by, once again, double digits, perhaps in the low teens this time. Overall, however, the company is well positioned to raise dividends. Once again, we're talking about a top 10 dividend growth stock, and we can't see the company passing on raising dividends this year. We think another raise in the cards. It is in strong financial shape and generates a considerable amount of cash flow. All this points to a comfortable dividend raise in January, and will extend its dividend growth streak to approximately 26 years. The last stock on our list is auto parts manufacturer Exco Technologies. Exco Technologies is one of the lesser known Canadian dividend aristocrats and is a small auto parts manufacturing company. It has operations across the globe with approximately 62% of sales generated by United customers located in the United States, followed by 16% in Europe, 13% in Mexico, and only 5% come from Canadian consumers. As you can see here, it has 15 manufacturing locations across 7 countries and more than 5,400 employees. It operates in 2 main segments, which is casting and extrusion and automotive solutions. If you'll see here, the company has struggled in recent years, although top line growth was pretty strong between 2013 and 2017. Over the past few years, it has dipped slightly. One of the main reasons is the struggles of the ALC division, which has since been sold and liquidated. And now the company's 2 main segments, as mentioned, are the auto solutions and casting and extrusion segments. Both of those have struggled mightily in 2020 as a result of COVID-19. As you can see here, it has been significantly impacted in the second half, with Q3 revenue almost being cut in half over 2019 levels. So the company really has been at the mercy of COVID-19, and the economic lockdowns have had a pretty significant impact on the company. On the bright side, the company has seen profitability rebound in a big way in the fourth quarter after posting a net loss of 2 cents per share in the third quarter. The company is still not out of the woods yet. There is still plenty of opportunity for disruptions given the uncertainty around the pandemic. However, the fourth quarter was a nice rebound after a tough third quarter. The company has an 11-year dividend growth streak, over which time it has a 15% compound annual growth rate. That was then, however, and this is now. The growth rate has shrunk significantly, and last year it only increased dividends by 6%, which is the lowest by which it has raised dividends since the dividend growth streak began. One of the reasons why we believe the company is at risk of not raising the dividend is because of the significant impacts of COVID and because uncertainty remains. On the bright side, however, the company is still generating a ton of free cash flow. As you can see here, the dividend accounts for only approximately 35% of free cash flow. So the dividend is still well covered. And although it accounts for 64% of earnings, accounting for only 35% of cash flow, it still has room to grow. The question is, will it grow dividends, or will it take a cautious approach and perhaps delay raising the dividends until later in the year, until there is more certainty? In our opinion, the company has the financial balance sheet to raise dividends. We do question, however, if it is the right course of action given all the uncertainty that still remains. We'll see come the end of January, which is when the company is going to be expected to release quarterly results, at which time it will make a dividend announcement. If it does raise dividends, we don't expect anything more than low to mid single digits, in line with last year's raise of approximately 5% or so. And that rounds up the companies which are expected to raise dividends this coming January. To kick things off, Atco and Canadian Utilities are expected to release quarterly results in early January. They are all but guaranteed to raise the dividends. We expect somewhere between the mid to high single digits. Follow that, Metro and Canadian National Railway are also 2 top 10 dividend aristocrats, and we also expect them to raise dividends near the end of January. And Exco Technologies, which is a smaller dividend aristocrat, is 50-50, if you will, on a potential dividend raise at the end of January. It is well positioned, but it might be prudent to keep the dividend steady given the current uncertainty. Please let us know in the comments below which one of these 5 are your favorite Canadian dividend aristocrats. Personally, I own CN Rail and Exco Technologies. I do like Metro, I've just never found its yield to be particularly attractive. Finally, I've always avoided Atco and Canadian Utilities simply because I'm not all that impressed with their potential growth profile. I prefer other utilities that have a higher earnings growth rate. Nothing wrong with Canadian Utilities and Atco. They are among the best dividend growth stocks in the country. I just prefer a little bit more growth out of my investments. And with that, I'd like to thank you once again for tuning in. We hope you had an excellent holiday. Looking forward to a new year. And as a reminder, we do have a New Year's promo running. Please check the link below for additional details. And as always, please like the video and subscribe to our channel for more great Canadian content. Till next time.